Welcome aboard. Please tell everybody where they can find your works to start this off, because they're going to want to know that information at the beginning and into this program for sure. And your general opinion of what we've just witnessed over the last 10 trading sessions.
All righty. Well, it is Samantha LaDuc, and you can find me obviously right here on this X platform at Samantha LaDuc. I run a financial research firm at LaDucTrading.com, and it's not just me. I've got a whole team. So it's 10 analysts, educators, and traders, and we share our insights, macro to micro. That's it in a nutshell, and clients retail to institutional. So I'm trying to bridge the gap between retail and institutional. So I like to go across all assets, and I find lots and lots of correlations and divergences, which help me with my market timing. And I also go and do all that analysis and trade setups across time frames. So chase, like today with this rip-roaring little bounce that we finally got. And then swing and trend time frames, and swing is more my bread and butter. And I'm an options trader as well, so that's part of what we teach and also trade. That's it in a nutshell.
Fantastic. So let me you just hit my magic button that I've been discussing with every trader that I can. Whenever I have a discussion about this, what do you make of the evolution, especially with zero-DTE options, zero-dated options, and the retail traders getting involved as young as 18, 19. I think it's great they're getting involved, but I don't think they understand risk profiles, and that concerns me. So let's get a professional's take on this. Please take it away.
Oh, I think the youngins coming in. Okay, stop it. I actually didn't get into this until September 18th, 2008. So I consider myself young in the industry, young at heart as well. I think it's fabulous, actually, the fact that they have come in mostly post-COVID, right? They had time on their hands. And they wanted to make, some income. So it's also speculation. Money was just flooding into, risk assets, inflationary assets. So it's wonderful. Some of them won't make it. It's not their cup of tea. Others will absolutely learn how to compound wealth and stick around for the long term. It's been very good for brokerage firms, obviously. And of course, speculative assets like Bitcoin and all the transaction fees. So I think it's great. It's the next wave, if you will, of financial education and wealth creation. However, they came in where stocks only go up. And literally the past 2 years, they're kind of like, hey, stocks only go up, but they don't maybe realize some of the macro drivers, that it's policy intervention and then more policy intervention. And every time we look like we're about ready to cliff dive, both equities or bonds, it's policy intervention. And now we've got re-rating of earnings, re-rating of GDP growth, re-rating of all things that we took for granted as it related to policy intervention. They're not coming in. They're not coming in to save the markets. So it's exciting, as it relates to people are experiencing yen carry trade unwind last August, where the markets quickly fell, right? And that was a 15% pullback for NASDAQ in a month, 35% for NVIDIA. So they're like, hey, what's up? And now we've got actually a distributive top in play. So they already know, I think the new traders coming in are very good with the data, but they just don't have maybe the experience that we have, because we've been doing this a little bit longer and we've lived through a little bit more turbulence and volatility. So I actually make volatility my gig, which is to say my number one job is to help clients know when it's safe and when it's not. So I study the macro backdrop, and then all of this policy intervention as a way to say, hey, they've got our backs. And then recently, no, guess what? They don't. They really, really do want to take some of the air out of the bubble and focus potentially on Main Street, but also kind of, create this destabilization effect, which is towards their goals, which I don't think many people understand, that this is really organized chaos. They want the value of the dollar, I should say the demand for dollars to fall. And as the value of the dollar falls, then that will, in time, after much pain, create potential tailwinds for our US exporters and manufacturing. So the only way to do that is to really help kind of force money to go home. So since 17% of equities are held by foreign interests, guess what? They're leaving. Not all at once, but it is controlled selling. And it is actually for lots of reasons, not just profit taking, because of economic growth slowdown that's now being priced in, earnings contraction, but also yields are higher. That stimulus in Germany last week, boom, they're going to go chase that. Japan is hiking. They were negative, now they're positive and they're higher. And then, of course, China's doing a lot to stimulate consumer confidence and or consumption, more likely consumption versus direct fiscal like we had post-COVID. But the point is there's lots of money that's now chasing opportunities abroad, and the value of our dollar is falling, and yields, that's the goal, is to also help put those under control, because if they don't, we're going to be in big trouble, right? We have way too much in the way of deficits that, by the way, have not been pared down with this most recent continuing reconciliation bill that the Dems just agreed to. And without fiscal restructuring, fiscal control, that our yields are going to continue to move higher, which will break the dollar, which will put amazing negative pressure on our bond market. And so that's why Besant has come out and said, nope, we're gonna support bonds over equities. We're gonna tap down inflation by pushing lower the dollar yields and oil. And right now they've done a good job of talking it down, but now the policies have to actually work. And that's where a lot of folks don't have a lot of confidence, and it's to be determined. It's to be determined.
Well, that is a fantastic synopsis, because you're spot on with your analysis. This was a very orderly decline, widespread distribution, large blocks. You could see it if you follow it in the channel down until today's bounce. That brings up the concern. Is it going to continue to be a news-driven market, in your opinion, or should we just watch the yen and the 10-year Bund in Germany and play it against those two?
Oh, there's tons of correlations that I follow. In particular, yes, rate spread differentials absolutely matter. They're a tight fractal with equities, which is just a fancy way of saying, money chasing yields abroad. We also have volatility that has a very strong track record of being suppressed, especially under the prior administration. They were in coordination, tight coordination. I mean, you had the White House, the Treasury, and the Fed, very tight coordination on the messaging that they presented. We're going to backstop the markets. We're going to backstop the markets, right? Whether it be the October 2022 central bank intervention that was global, 1.5 trillion, Matt King said, of Citibank. And that was during the Guild crisis. And also, by the way, the yen, they did an unscheduled. Anyway, the point is they came in, and then again in March of 2023 to backstop the banks. And then again, that timed with NVIDIA's 2023 blowout earnings, and the rest was AI drama excitement. Right into the November 1st, 2023 Fed pause and Yellen Yahtzee. That's what I call the short duration of issuance to fund the ever rising deficit. So that's what now needs to be rolled, right? What, 7 trillion? Like it's a ginormous number, and it's all short duration. And Besant really can't do much with that until the debt ceiling is resolved. And so we're looking at October. But long story short, that is one of the other reasons why they need yields to soften. And one of the ways to do that is to trigger a growth scare. So it's a deflationary impulse where, not just the dollar is falling because money's going home. That's my thesis of the past few weeks. But yields also soften with oil, and the energy costs are short term, seen as a recessionary risk, but longer term as a hit to that inflation pressure. And right now we don't see that. We just see consumers and corporations freaking out, right? Confidence is off a cliff, is just cliff diving. But ultimately, this is the policy intervention is the other kind, the kind we don't like or we're not used to, where literally, Powell and Yellen were just tightly coordinated to come in and make sure that equities were well supported. They wanted to get their guy or their gal elected, and literally the NASDAQ doubled from January of 2023 until December of 2024. we have a new regime in place, and they're trying to, to do the opposite. They're actually trying to tap down the wealth effect, and that is going to slow down growth and demand, which will also bring down yields and energy. So supposedly, but the tariffs are terror right now, and everyone's kind of struggling with, okay, what's next? The controlled selling was gorgeous. Like, thank goodness we didn't have it. Let's just say trigger a crash. We actually had controlled selling, which was volatility stayed bid until just this Wednesday, by the way. Tuesday, I mentioned to clients, we're having this situation where the IV, this VIX expiration that's coming up this coming Wednesday, very likely we're going to have IV now start to fall. So this implied volatility. And as VIX softens and falls, we stay below 30, then we're going to actually have an opportunity for stabilization. And that really has happened the past few days. And then today we obviously got our nice little dump in VVIX, which is volatility of VIX, and it all came together. So I've actually been bullish into stabilization, but we're also on a level, if we don't hold, we can trigger some more forced selling. But until now, it has been just controlled selling all the way down. We didn't have a macro trigger of a government shutdown, so that is also relief, but we're not out of the woods. The dollar will continue to fall as money goes home. Equities will continue to be in distribution as the money is foreign, takes and sells. So there's not a lot of incentive to stay now. Also, the AI stories, right? The story stocks have come under massive distribution. Will they have a bounce? Absolutely. But will it be sustainable? I don't believe so. So now you've got all the wirehouses coming in, Citibank earlier this week, and then JP Morgan followed and said, we're going to downgrade these overvalued US stocks, and we're going to upgrade the oversold China tech stocks, which have already risen like 60% year to date. So this is going to be the theme. The market hasn't yet figured out how to re-rate earnings. They're struggling to figure that whole thing out under the terrifying tariffs, which have not been resolved. So if Trump was to, turn around and say, you know what, I was kidding, then we would absolutely spike higher. But that's not going to happen. He wants tariffs. They're going to happen. To what degree and how they're rolled out is what the market's trying to price in. And in the meantime, we're just bopping around intraday with massive volatility. And it did start to seep, right? It started to move from the inside out until Wednesday, when we had structural flows come in and literally take some of that air out of the VIX bid. Very large calls and call spreads closed because we have this March expiration. So it's pretty mechanical. So now we're waiting for the next level, which is either these price insensitive mechanical flows start coming in, not just today, but follow through. And I'm talking risk parity, vol control, CTAs, and they bid it up, and we get right back up into 57, 5,800, yeehaw. Or we get a macro trigger, and the opposite can also happen. We still have some very large supply from these funds that could trigger more selling, forced selling, or price insensitive selling. But right now, that's not the feel. The feel is we're stabilizing, and we've got to get through next week. Next week is FOMC, Bank of Japan, and the German parliament votes. But that's all of those three are already kind of assumed. And then we have options expiration, which is the triple witching on Friday. And then we can go about our merry way pricing in equities, whereas next week is very much focused on just holding on to equities while we get through some of the macro event risk.
Well, if I'm reading this into what you've just spoken about, you're viewing it sort of the way I do right now. We've got our bounce today, low volume, low volatility, very structured, nothing crazy. Retail, there's no fear apparently on the retail side. So we're watching a level of stability that will probably carry through to the middle of next week, as you said. My concern is not what the Fed does. We pretty much know they're going to stand pat. But if the Fed comes out with a statement still expressing inflation concerns, that could put some more uncertainty into the bond market. And I always felt the bond market is the driver and everybody else is riding in the bus. And there has been a lot of unusual activity in the background of the bond market in the dark corners that people don't really want to look at, especially when you start seeing distress rates and CRE, et cetera, starting to build cause. Do you think that there are some unknown unknowns, as people like to say, that could surprise from the macro perspective that perhaps the fiscal side and Washington are not paying any attention to?
Well, they're the CRE isn't really front and center, if truth be told, but credit spreads are, meaning what we had this past few weeks of puking equities have 18, 19, 20 days in a row, whatever, 3 weeks, actually caused credit to follow. So credit spreads, I'm speaking, if anyone looks at high yield OAS, you can kind of see the level that we have risen during this controlled selling. If we were to start selling some more, we're on critical levels like 5,600 for those who are in ES. I've got very, very specific kind of Fed liquidity tools. We're right on that line of sand where we cannot afford to lose any more liquidity. And that's the problem that the market is experiencing. It's a lack of liquidity, hence the selling. We've got profit taking. We've got leverage unwind. We haven't even had an FX or a currency volatility trigger. Be grateful. It doesn't mean we can't have one. But the point is, if we do have more selling, then that is when credit will start to catch up in a crisis kind of way. So right now, we don't have that. That's the one big caveat I would say is in this in the green shoots of stabilization. That was my my client post this morning, and I listed all the reasons. VIX backwardation. We're out of backwardation. That's very, very helpful. We had been in backwardation since February 21st. And that's a big deal because when the front month, the VIX goes into backwardation, for those who follow it, we actually fell once we triggered backwardation, 8.5% of the 10% drawdown. So there are firms that actually go to cash when this happens. Sometimes it's a garden variety backwardation like we had on August 5th, right, with the yen carry trade, or again on December 13th, the SPY triggered a negative 3% day, down day. But those were very short-lived and they were also bought aggressively. The controlled selling nature of this actually created backwardation back on February 21st. And then the market sold off 8.5%. That's a big deal. The fact that we came out of backwardation today, it's only one day, we need follow through, is also very constructive, right? So I'm looking at all the green shoots. That's my job. So I can expect the VIX IV, crush. I can look at backwardation coming, going back into contango. That's positive, et cetera, et cetera. I can follow my growth value ratio analysis, which is very much focused on, okay, is this momentum, this growth scare done for now? And we're going to go stabilize and do some oversold bounces because those puts need to get monetized. Remember, as IV starts to fall in the volatility products and they are, approaching their expiration, those puts are actually losing value very quickly. So people are forced to kind of close their hedge or, convert it into a put spread or roll it out in time. But the point is, it does trigger more of those hedges to close, which also triggers the dealers to cover. You get the point. It feeds, it all goes together. So that's why I track sector rotation, because I have a saying, in lieu of sector rotation, that growth to value, value to growth, there will be volatility. And we never had a big swoosh of volatility to really make it exciting to go in there and buy equities. There were no buyers, by the way, that came in. So I study breadth underneath the surface, and I warned literally on Tuesday the 18th, and then again on 19th of Wednesday, before the Friday on February 21st, warned that we were getting into this bearish rollover because I could see the selling underneath the surface. And we have still, even today, no joke, today's the first day of buyers I saw come in. First day. So we still have a lot of work to prove this and to follow through. It's not just a one and done, but it's a really good sign that we've stabilized this week. We had a nice follow through today. Now let's get through these macro event risks next week. and then build on short covering rally. That's what the folks are going to get excited about. The problem is the problems haven't started. I haven't stopped, right? The re-rating of equities still needs to be done. The recession risk has been pulled forward on economic growth. We are not any further along in solving the problems of tariffs or trade wars. So all the problems that exist don't go away. That creates an opportunity for selling into the bounce. And that's where we're going to have to really reassess after next week.
100% agree. And in your piece, the strategy of chaos, yes, a lot of us do follow you in the shadows. You made a great point that we haven't triggered a 2 standard deviation move yet. And I find that somewhat disturbing, not so much from the perspective of the volatility being tamped down or contained, so to speak. It's like you said, we've had orderly selling, but we really haven't had that capitulative panic to the exits. And that's where I'm a little bit concerned about the stability of any rally heading into this month. And of course, next month when President Instability starts his tariff war and trade war with all of our partners.
Yeah, that's it in a nutshell. We are the exit liquidity. So that is just more proof, right? The fact that we can't really get a solid, volatility spike to buy into, like we had with the yen carry trade unwind back in July into August 5th. It means, in addition to the dollar that continues to lose, altitude, because normally people are like, wait a minute, the stock market has just fallen 10% and the dollar fell with it. Well, guess what? The dollar didn't just fall with it. The dollar was the volatility. The dollar had a 4 standard deviation move in 3.5 days. Unprecedented. Not since November 2022. I wrote about that as well. Money's going home. Dollar didn't spike because we went lower in equities. Nope. Money's going home. So that's the control. We are the exit liquidity right now in the US. That is going to continue. They don't have any reason for it not to continue. The overvalued nature of our market, the overvalued nature of the dollar, this is not going to slow. We're just going to get these occasional bounces, and then we'll short that, and then we'll just continue rolling over. We're already pulling forward the second half risks into Q1. So we'll have more opportunity in Q2. And then remember, Q2 is really, May, June, we're going to start to price in 2026. So this is going to be a tough year. This is going to be a year of volatility, but it's the durable kind. We can have some spikes like we had for the yen carry trade, but for the most part, it's a durable kind. That's the most dangerous for equity investors who are trying to buy the dip.
I think you have just nailed it in one quick summation, because most people don't understand the risks heading into the second half of this year being brought forward like this. And we are going to sit there and witness growing instability in the bond market should this exit continue. What do you think the implications of a sub 100 DXY, Dixie going below 100, I think has major implications for confidence in the currency markets and in the US markets. What is your take on that?
We're going there. That's the administration's goal. That's not a bug. That's the feature of it, of electing Trump, Besant. That is their goal. So that the dollar is falling as money goes home, which is what they want. And that does bring into, the play, of course, breaking 100. We're probably going to break 90. So that has implications. There's no question about it. The downward repricing of U.S. growth, Fed is trapped anyway. They'll cut later. But that combo deal, the American exceptionalism, I'm not just talking about, China eating our lunch as it relates to this, AI tech, DeepSeek, DeepSixed the semis, and then it followed through with the Baba Quen and then Manus and their quantum leaps and their energy and their science. And they're making a full press on American exceptionalism. Full stop. And they've done it really, really well. And now the US investor is starting to also worry, and they're exhausted by all the headline risks that they have to try and manage with Trump. And Lutnick coming in and trying to help salve the market isn't. Besant is very clear. Nope, we got to detox. If you really, really wanted this continuation market, you would put the US on a path of of sovereign debt risk, default, what have you. And we really, really need to fix this so it doesn't happen. And that's ultimately what they're trying to do. So to repair all the excesses, and it's in a chaotic way, I'm not going to excuse the administration in any way, shape, or form, but we cannot afford higher 10-year yield. I've got a fabulous classical economics advisor on my team, Jeffrey Fouvray, and he is, oh my God, so in tune with your favorite market bonds. Not everyone is into, emerging market debt and arb trades and precious metals and fixed income like he is, but this is his absolute wheelhouse. He's like, Samantha, they know we cannot get into a situation where the 10-year goes above 5%, becomes 6%. Historically, if interest is 30% of revenues, your currency collapses. The bond market collapses. They can't go there. And so Jeffrey, what is that level that would create 30% interest on US revenues? And it's 6%. So they're going to do whatever they can to push down the dollar, yields, and the energy costs. Full stop. That is their plan. So go with it. Don't fight it. But it's also going to have some backlash, and it's also going to have some blowback, and it's also going to frustrate, because the analysts are not re-rating stocks based on this policy course. It has one analyst switched from buy to sell for NVIDIA. Nope, they're all still buy, right? They have not even come down into contemplating this recession risk as a result of the policy decisions. That nothing has been re-rated yet. The market's doing it for them. They'll catch up with us later, and then we'll sell off some more.
That has got me somewhat terrified because there's been a dramatic misallocation of capital in the last 7 years. And I go back to December 2018. Most people don't remember that. I mean, I'm a lot older than you, trust me. And I remember seeing all of the policy mistakes in real time. And it's just like, oh my God, they didn't do that. And the Christmas Eve massacre of 2018, everyone forgets that. The Fed is prone to making policy mistakes, as is Washington, D.C. And we have misallocated capital for the last 7 years in ways that I could never imagine. If we see any kind of policy mistake, especially with the trade war, what kind of implications does that have?
So I actually love this example. First of all, this misallocation of capital. We come on, we know it, but the market is drunk on it. So it's kind of like, come on, we got to take away that punch bowl now. No, it's screaming not to leave the party. It is absolutely in pure denial. So anyway, the misallocation is there. It would be much better, instead of financialization of stocks, to actually put it into projects and people. The thing I call things over paper. That was my mantra back in literally 2020, that inflationary assets would be of value. And of course, stock market is also, an inflationary asset. But the point is, at some point, we really have to transition into a productive use of capital. And we missed so many opportunities. And now that's also part of the unwinding by this administration, either by design or default. So whether they're doing it on purpose or they're just screwing it up, you can pick whatever side you want. But the point is, that is what is being forced on us. So that whole financialization of market returns, then that has happened, especially post-COVID, has then created this wealth effect. And the wealth effect from equities, and everyone says, it doesn't lead the real economy. Oh, yes, it does. Oh, yes, it does. So the economy is more vulnerable to a stock decline now than ever before. Because our households are massively overweight the stock market. And the Mag 7, that concentration risk, or you can call it, the SPY top 10, right? But whatever, the point is that concentration risk in the heavily weighted stocks that make up the composition of the S&P and really drive the returns are 36% of our GDP. Never, ever, ever before have we had that type of concentration in our equities market. And this makes the fall in those key heavily weighted stocks a direct hit on our economic growth. Direct hit. So that's where we're at. We have to unwind that excess, that bubble, And hopefully it will be slowly, not all at once. And that's basically why I think the market is also trying to compare Trump 2.0 to Trump 1.0, and it's not the same. It's not the same. It's not the same man. It's not at all the same policy goals. He's really doing the heavy lifting of saying, nope, we want the foreign money to go home. We want the foreigners to go home. We want the, their involvement in businesses, real estate to go home. We want to isolate. We want to build it ourselves. We want to. So it's a very disturbing. I think the market's still in denial that this is actually going to have a ramification on everything they have gotten used to. And I know many people think that they're going to do QE at some point. The market gets too oversold. I don't think so. I don't think so, or it won't be so easy, even though I know that's very consensus, by the way. I know I'm very, very anti-consensus, but I was also of the opinion last June that no matter who got elected, we were still going to have a recession risk pulled forward at the second half of 2025. All Trump has done is pulled it forward. And I remember in December, I did an update interview with the same guy that I had done it in June, where I said end of 2025. And I've never had a recession risk call ever in this whole COVID drama. Nope, not once, until last June for this year. And then in December, I said, now Trump's really just going to pull it forward. And that's exactly what's happening. So we're pulling forward, and folks are like now saying, okay, so where do we cry uncle and when do they come in with QE? And again, I'm going to point back to that interest rate problem, that we have too much interest on our debt now to allow rising US yields. Believe it or not, money chasing yields abroad is also helping us. Bigger picture, we have a trade deficit we have to deal with urgently, etc. But I think people are kind of looking at the script of he's just chaotic, with actually there is means to this madness. So I'm looking at that going, we're going to have more pain. And it's not just because we're overvalued and people are finally wising up. No, that's not it. It's because money's going home and because the economy is more vulnerable to a stock decline. And analysts are very slow to embrace the fact that this is not a bug. This is a feature of falling dollar yields and energy. And they're going to have to get repricing of everything. And they're just very slow to do it.
Well, that's pretty scary, Samantha, because people don't understand something. And I'm going to ask you a question about that in just a second. We got to take a quick commercial timeout. Everyone, macroedge.net/ozone, macroedge.net/ozone. Get your 2-week free trial. Check out the information the MacroEdge team brings forward. Samantha, this brings to the point when you're talking about equities and interest rates. The one demographic that is most impacted by this are retirees. That's why I wonder how they'll address that.
But what do you mean specifically? I mean, they benefited from the wealth effect more than anybody else in the history of the stock market and the economy. So in such a short period of time. So they're going to deal with it by losing potentially the inflationary effects of higher interest rates. But it has to happen. If it does happen, that's a big question. If it does happen, if the Trump administration can actually curtail spending by Congress, which, by the way, still has the pen and still has a checkbook. So DOGE is only so effective at, cutting people out of the government, shrinking the government, and then pushing them on the private sector and expecting them to be absorbed is very, very difficult, right? We're not set up that way. When most of the growth that came to GDP came because of government spending and hiring. So the jobs came from the government sector, not the private, right? The money flow came from stimulus and monetary easing, and it came from government policy intervention and government programs. So all of that is now becoming unwound. How can anyone who, thinks about this logically say, we're still going to keep going up though, right? Why? Why would we? Like we have to go into a contraction in order for us to rebuild again. And they're just focused on the contraction right now, trying to talk, folks down from the ledge of don't worry. It's, it's going to be okay. But I'm not saying depression. I've never, ever uttered that word. I'm not saying big, huge recession. I'm saying right now there's very controlled selling because the writing is very clear that although we can still have some rip-roaring rallies on mechanical flows and the excitement about these balance sheet heroes, and AI, headlines, there'll always be some story to tell. But ultimately, we do not have the growth engine anymore from the government stimulus and jobs. We have the opposite. And in fact, the expectations by economists for 2025 for GDP growth were stupid high, like unbelievably high. That's also disappointment. So models were based on these earnings expectations and GDP growth that are now being re-rated. So that's been my thesis for the past month, that this was going to happen, that we were going to have to re-rate companies, re-rate the economy, and basically money was going to go home. And I tweeted about this, I wrote about this. It's falling demand for US dollars. That is the trigger, but it's also the design of the administration. That's exactly what they want. So we're going to have the pain from that. And then later, hopefully, if everything works out okay, if you believe they can pull this off, tariff and trade wars, and deficits, oh my, then we should start to rebuild. The big question in my mind is not to make light of it, is, trade wars are, what did Buffett say? They're acts of war. Tariffs are acts of war. That's literally a Buffett quote just recently, by the way. And he's the GOAT. But it's the deficit. There's nothing that's going to be fixed. Nothing that's going to get fixed unless they can do serious fiscal restructuring. We're going to be in a pickle because we don't have bonds will smell it. They'll say Doge is just, not going to be enough, right? So that's where I'm actually more focused on the longer term, is what happens with, the yield curve steepening and the hit on equities, because bonds do not believe that we're actually going to get any control of our fiscal spending. So for right now, markets in a stabilization zone. That's what people kind of care about, and the bounce that they can chase, and whether or not to go in and have the confidence to bid up equities, especially the ones that have been heavily sold. But honestly, I think we're just going to have this continue through the whole year. That's been my thesis going into this year. And the reality is, I thought we would get through Q1, sideways. But we actually, in the past, 3 weeks, we wiped out all gains going all the way back to the July yen carry trade unwind. So the market's serious about selling off, and I don't think it's going to be done just because we have some mechanical flows that give us a nice Friday bounce.
Well, I think you've nailed that as far as the mechanical flows are very easy to identify with the structured selling that we witnessed all week, especially if people pay attention to the minute by minute moves. One of our listeners, our team has a question for you. It's the question is, the companies with market caps in the tens of millions to single digit billions look extremely unhealthy right now, with deteriorating cash flows a major concern. Where do you see unemployment towards the end of this year as tariffs increase costs for these companies that do not have the scale of the mega caps?
Yeah, that's the other trouble, right? We haven't even really talked about that. It's ironic because that CFOs have really stopped hiring, so they're trying to brace for impact as well. But the unemployment rate is not likely to spike so much higher, which will be a kind of like a false flag, meaning because of efforts by the administration to deport immigrants, which is very much a big hit in lots of industries. There's no question about it: construction, agriculture, et cetera. And then a big hit on government employees and all the contractors that feed government contracts, right? There's like 3 employees for every one. There's 3 civilian employees for every 1 government employee that is a big hit. Right. So we have this white collar recession. We have this blue collar recession, and all of that employment slack right now is, in other words, we have fewer employees for the jobs that are going to be available, which are also falling. It actually does not mean that the employment rate is going to start rising aggressively. So it's these other kind of medium, like you're talking about, the mid cap companies that are looking at tariffs going, how do we absorb this and how do we navigate this? Of course, it depends on the sector. They're going to have a really tough time. But we know that just But the data right now is a little early on whether or not this is going to follow through. So a case in point is lumber, right? So I happen to follow the construction business industry very, very closely. But as soon as Trump said 25% tariffs on Canada, and they looked like they were going to follow through because they weren't really playing ball like the Mexican president was trying anyway. So I said, oh, no, it's not 25%. It's actually, there's already a 14.7% levy on soft lumber. So now they've just added 25%. So now it's 40%. And then recently this week, he gave us a zinger of another 25%, right? He's trying to make his point. But the point is that 40% hit on lumber costs, okay, now trickle down. Immediately, I'm like, forget home builders. They are not along. I don't care if rates are dropping. Forget about it. They're not along. Home Depot, a long-term trend long, I dumped it. And I said, nope, I love this company. I've loved this company. This, you know what their number one line item is? 2x4s. So nope, I'm closing that. Like these are decisions around lumber that impact home builders, they publicly traded companies. Now think about all the contractors. Look, all the feeder businesses that supply the construction world, lots of small and medium-sized companies. I mean, they're getting hit on the inflationary increase in the cost of goods, and I mean huge increase since COVID, on top of labor doubling in price, not to mention insurance costs, 4x. Passing that along or being stuck in a contract that they can't even negotiate because of tariffs, it's a big gnarly problem for businesses right now. It's tough. It's tough to navigate this. We're going to see more bankruptcies. So this is the knock-on effect of the chaos, right? And they're not going to come in like Biden and his foolish stimulus to just give everybody free money, whether students or homeowners or, whatever. It is the opposite problem. We're not going to get that at all. There isn't going to be support. So there's going to be a lot more labor shedding. There's going to be a lot more margin compression. There's going to great. We're going to get less regulation. Super. And some companies are going to navigate really well they're going to be in a sweet spot. They don't depend on maybe a lot of foreign-born national, right? And maybe they're maybe they pre-ordered all their lumber. I mean, there are always going to be the exceptions. But my point is, it's going to be very, very tough for private industry to navigate this recessionary backdrop for 2025 and potentially 2026. So that's a long answer to unemployment may not spike higher, but it is absolutely not going to go down.
You're speaking to someone who's written several articles about how the unemployment is not a reliable recessionary indicator, as it's always the lagging indicator. It's always the last thing to reflect a recession, usually when we're mired in the deep middle of it. Everyone forgets 07, 08. Well, guess what, folks? You didn't see it really hit until after the fire had already consumed the forest. That is a point that people need to understand. Quit using unemployment as a gauge for the health of the economy. Look at the availability of credit, the numbers as far as how consumers are behaving. And I think Monday is going to be a huge day with retail sales.
What was the last part? I didn't hear it.
I'm sorry. I think Monday with the retail sales report is going to be huge for the market. I think it's a dangerous point as far as data points go.
Yeah, it's definitely, we've already seen it soften considerably, but it's also, to your point, I saw a great reminder that during, 2000, I should say the spike in 2000 high, we rolled over, not because we had high unemployment. It was like 4.1%, but we created high unemployment. So the tech wreck of 2000 to 2003 caused unemployment to rise from 4.1% to 6.5%. So in keeping with your comment, right? So this is why folks are like, but we haven't spiked higher in unemployment. No, that's not, it's going to create it. We're just starting now. We're done going down. Long story short, we may not have triggered the SOM rule, but we may have a slack that's going to make that denominator look, good for a few months. But at some point, this is what I have been writing about and talking about for months, is that this is a big hit. Wall Street will impact Main Street. There's no getting around that. And people who think that it's not related, they're going to see that it really, really is. And the case in point, a 10% drawdown in the equity market over the last month has I forget what was the impact. Hold on, I can show you. I mean, I can tell you if I grab this 2 seconds. Has a impact of 12% of GDP. Shocking, but that there are some big numbers here that people aren't kind of, I think, modeling in. Anyway, we'll have time to get there. I think it's still, kind of like I said, early innings, but folks are waking up, and that's great. But it's not great for equity returns.
Absolutely. And boy, you almost got me on my soapbox about quality of data and statistics from the government. Let's hope they fix that also, so the modeling can get a little bit more accurate based on what they tell us. One of our listeners, Sensory, I believe it is, wants to ask you a question. Go ahead, please.
Yeah, I just had a quick question about what your thoughts are with interest rates. I know based on everything that you're posting that they're really watching the 10-year and trying to bring that down based on our need to refinance debt. Do you think once that cycle happens, they might kind of shift course and take the tariffs off and just say, oh, we were fooling everybody? Or do you think this is like their long-term plan to try to get us out of debt?
Oh, I don't know what their long-term plan is. This is that would be awesome. But probably not. Probably they're, going to keep these tariffs going because it incentivizes, it forces investment at home, and it forces consumption at home, and it forces employment at home. So I don't think the tariffs are going away, and I don't think the way that they're being rolled out is helping matters. But long story short, I don't think the tariffs are going to go away. Not under this. For sure, not the next 4 years. This is going to be the goal of forcing somehow others to absorb bond issuance. That's always been a thing. It's called bond stuffing. But it's also to have the demand of dollar fall. And right now they're settling. Lots of countries are settling in gold, even silver, as a means of trade. So they're not needing to recycle dollars so much. That's good actually for Main Street. It's just not good for Wall Street. And I think that the 10-year can have a lots of let's just say impact right now on the psyche of, wait a minute, if it falls, we're in a recession. And yet if it falls, we are helping to have a lower service on the debt, right? So it's good, bad. It's pulling forward recession risk, but it's also really, really, really necessary. So I think this is still going to be, like I said, it's not a bug, it's a feature. The worry is, if, at least I have anyway, is if it starts to move higher, they do QE, which would be dumb. They do not control the fiscal spending, which would be dangerous. Then we will have rising yields. And although short term, it makes it really kind of rosy for companies that have lots of cash, right? They make money on their money because they invest it, or boomers because their house is their main inflationary asset, and of course assets that they're tied to the stock market, really, really good. But the problem is it's bullish until it's exceedingly bearish. So the higher yields rise now moving forward because of where we are, 125% debt to GDP. That becomes this self-fulfilling cycle of we force the currency lower and bonds lose their value as collateral, and that can create a sovereign risk. So a country is likely going to hit it before us, right? UK is in a much worse situation, France. But that aside, I'm just saying right now in the short term, their goal is to stabilize the 10-year and not allow it to move higher. In the past, they did it, Fed, Powell and Yellen did it through intervention, policy intervention, short duration bills that added liquidity and tapped down the dollar and yields. That's not Besant's role. He says, nope, I'm not going to do that. I'm going to do longer duration notes and bonds, but later. He's not going to do it for the next few quarters. That's liquidity sucking. That's going to be another opportunity for money to go home. So I think they're going to be really, really using the negative wealth effect of the market to drive down demand, which will also unfortunately trigger labor shedding, recession risk, and that's their way to keep yields under control, that and the dollar from being bid up. And they're probably going to, keep energy costs really, really, really suppressed as well, so that we don't have a spiking higher inflation surprise, because then yields rise. They don't want that either. So I think it's going to be very controlled. I think the 10-year is going to be very controlled.
I tend to agree with you. I think if we did have a worst case scenario, I could even see the Fed getting into yield curve control. And we don't even want to talk about that. The implications of what that would do.
Price control doesn't work. It just spikes yields even
everything
higher.
Else. Yeah.
Yeah. But I found that number, by the way. It was Warren Pies, and he said, because households are massively overweight stocks, the current 10% market decline has created a wealth shock equivalent to 12% of GDP. So wealth shocks are rare, only 13 since 1950. His point, and I just put it on my Twitter feed, so at Samantha LaDuc on X. So I found that. I had it in my mind's eye, but I wanted to get the data. I pushed that out on my my Twitter feed if you want to look. It's not called Twitter anymore. X, whatever.
It's still Twitter to me too. Trust me. It's going to be Twitter until he starts sending me checks. It's going to be Twitter. Well, Samantha, your time has been fantastic. So let's get into the big question here. Do you see my fear is your fear, and it's quite obvious that we don't have the fiscal discipline in Washington with the political classes that we have. And for the record, I hate all politicians. There's a couple I like, but as a general rule, they're all terrible people because it's all self-interest instead of the greater public you're supposed to represent. And I fear that their lack of fiscal discipline will undo the hard work that Bessent's trying to impose on our society and our financial system, try and make it more affordable. Is that the tail risk that no one's looking at, that they just decide to play along with Trump, and then in the second and third quarter, let's face reality, there's not a continuing resolution that Trump hasn't agreed to sign ever. And that's what scares me about the market risk, that people are thinking that it's different this time, when in fact it might be more of the same or worse.
When you say it's different than this time, what specifically do you mean? Sorry.
That they're going to that Bessent's strategy will impose fiscal discipline on the politicians in DC, and instead they're going to try and maintain the status quo, which, as you've stated quite accurately, will cause a risk of higher yields in the bond market for the long term.
I'm worried about that too. Yes. In a nutshell, yes. So one of the ways that it'll kind of start to seep out, and it already has, is the gold rally that we've had since March of last year, right? So trade is now being settled in gold versus dollars, and that's going to continue. The petrodollar and all of that is as falling demand. The credit spreads right now are really kind of fake. They don't really represent yet, because equities have only fallen 10%. But I think credit spreads are the risk of repricing equities that triggers volatility. Yen carry trade, we had one little bout of it back in August. That's not done. In other words, there's so much in the way of speculative assets that is financed in extremely low cost yen, right? The low interest rates of Japan, that when that unwinds, it actually triggers what's called a basis trade. Basis trade is hedge funds that are, very, very short U.S. treasuries and long NASDAQ 100 have to unwind that. We're seeing that leverage unwind starting as money is going home. We're seeing not just profit taking and not just foreign interest selling and leaving, and that will continue. But we're also seeing leverage unwind. So put all together, this is a backdrop for a more unstable year or two in the equity markets. At the same time, we don't really have the deficit issue under control. So the bond market will continue to doubt Trump, and right now, Bessent has done a great job of talking them off the cliff. But for the most part, recession risk is now starting to, the odds are starting to increase. Remember at the beginning of there was zero chance across the board. Now it's 50%. So risk happens fast. And the only way that they're really going to get, I think, control of this is to let more of this wealth effect go and get control of spending in Congress. And then we'll see if we can stabilize, not just for the week, right? The green shoots of stabilization, but it's way early to predict how they're going to do with trade wars and deficits, like I said, and wealth effect leaving. We have a lot of work. There's nothing I've got for a crystal ball that says they're going to nail this. Right now, all they're doing is letting us know This is not a bug. This is a feature.
Amen. Samantha, please promote your website again. And folks, if you are not following her on Twitter, X, folks, please do. Please promote your firm again for everybody who may have inquiries or may want to sit there and participate.
Oh, thank you so much. Yes, I run a financial research firm at LaDucTrading.com. Group of us, very, very focused on macro to micro, from trading rooms, you're right, to options, education, to swing, trend, you name it. We do it all. We try to cover all assets and meet a trader wherever they are in their trading journey, including institutions. So that's basically it in a nutshell. And you can find me also on X at Samantha LaDuc. And I also have a mini me product on Substack at Samantha LaDuc.
Samantha, you have been a fantastic guest, and we look forward to having you on again sometime, because I have a funny feeling markets are going to be the center of the universe this year. Sometimes that's a good thing, but in a bearish phase, which people haven't been through in quite a while, I think it will be educational for everyone. Thank you so much for joining us today.
My pleasure. Thank you so much, John. Have a great afternoon. Great weekend, all.